If you're a property owner or investor looking to keep more of your hard-earned money, you're in the right place. Here, we break down tax-saving strategies, real estate loopholes, and wealth-building tips in simple, easy-to-follow steps. So, if you're serious about growing your profits and avoiding costly tax mistakes, hit that subscribe button and turn on notifications. Let's dive into today's topic and start saving. 1. Depreciation deduction. The IRS allows property owners to deduct the depreciation of their rental property, significantly reducing taxable income. Depreciation is a non-cash expense, meaning you're lowering your taxable profits without actually spending any money. Over 27.5 years for residential properties, you can claim a portion of the property's value each year, helping offset rental income. This strategy works because the government recognizes that buildings wear out over time, even if their market value increases. Properly applying depreciation can help you show little to no taxable income while still generating positive cash flow. Many investors use cost segregation studies to speed up depreciation on certain parts of their property, such as appliances, roofing, and flooring, maximizing tax benefits. If you don't take advantage of depreciation, you're leaving money on the table. Always consult with a tax professional to ensure you're maximizing your deductions without triggering an audit. Additionally, depreciation allows landlords to reinvest more capital into property improvements, increasing the overall value of their investments. The tax savings from depreciation can also be used to expand a rental portfolio, helping investors scale their business faster. Understanding the difference between straight-line depreciation and accelerated depreciation methods can further enhance tax efficiency. It's also important to track and document any property upgrades, as they can impact future depreciation calculations. When selling a property, landlords should be aware of depreciation recapture, which may result in additional taxes, making proactive tax planning essential. 2. 1031 exchange. A 1031 exchange allows you to sell a rental property and reinvest the proceeds into another like-kind property without paying capital gains tax. This strategy is completely legal and IRS approved, designed to encourage real estate reinvestment and long-term wealth building. To qualify, the new property must be of equal or greater value, and the entire sale amount must be reinvested. The process must follow strict timelines, with 45 days to identify a new property and 180 days to complete the purchase. Many investors use this method to upgrade their portfolio, moving from small rentals to larger commercial properties without incurring immediate tax liabilities. By continuously using 1031 exchanges, you can defer taxes indefinitely, growing your wealth without paying capital gains until you decide to cash out. This strategy is perfect for those looking to build a long-term real estate empire while avoiding hefty tax bills. Additionally, 1031 exchanges allow investors to diversify their holdings, shifting assets into different markets or property types while still deferring taxes. Proper planning and guidance from a qualified intermediary are crucial to ensuring compliance with IRS rules and maximizing tax benefits. Investors should also consider estate planning benefits, as inherited properties receive a step-up in basis, potentially eliminating capital gains taxes for heirs. Using a Delaware statutory trust, DST, within a 1031 exchange can provide passive income opportunities while maintaining tax deferral. Understanding how depreciation interacts with a 1031 exchange can further optimize tax strategies, ensuring long-term financial growth and sustainability. 3. Deducting operating expenses. One of the easiest ways to reduce taxable rental income is by properly deducting operating expenses. The IRS allows landlords to deduct necessary costs, such as property management fees, repairs, maintenance, insurance, utilities, marketing, and legal fees. These deductions directly lower your taxable income, meaning you pay less in taxes. Even small expenses, like replacing light bulbs or fixing a leaky faucet, can add up over the year, significantly impacting your final tax bill. Keeping detailed records and receipts is crucial to ensure you can justify your deductions in case of an audit. Some landlords miss out on thousands of dollars in tax savings simply because they don't track their expenses properly. If you have a home office used exclusively for managing your rental properties, you may also qualify for a home office deduction, further reducing your taxable income. Additionally, travel expenses related to property management, such as mileage, lodging, and meals for out-of-town visits, may also be deductible. Landlords can also claim deductions for professional services, including accounting, legal, and tax preparation fees, which can further minimize taxable income. Another often overlooked deduction is depreciation on equipment and appliances used for rental properties, such as washers, dryers, and HVAC systems. Even tenant-related costs, like unpaid rent or eviction-related expenses, may be written off under specific IRS guidelines. By maximizing these deductions and maintaining accurate records, landlords can significantly reduce their overall tax burden while remaining fully compliant with tax laws. 4. Writing off mortgage interest. For many landlords, mortgage interest is one of the biggest rental property expenses, and luckily, it's fully deductible. If you have a mortgage on your rental property, the interest you pay each year can be written off, significantly reducing taxable income. This is especially beneficial for new landlords, as mortgage interest is often highest in the early years of the loan. This deduction applies only to the interest, not the principal payments, so reviewing your loan amortization schedule can help you estimate your annual deduction. Even if your rental income is high, deducting mortgage interest can keep your taxable income low. Refinancing can also be a smart move, as lower interest rates can reduce both your loan payments and your tax liability. If you have multiple rental properties, your total mortgage interest deduction could be in the tens of thousands of dollars per year. Additionally, points paid to secure a mortgage on a rental property may also be deductible, offering further tax advantages. Landlords should also track interest on home equity loans or lines of credit used for rental property improvements, as these may be deductible as well. Another key factor is ensuring that your mortgage interest deduction aligns with your rental income, maximizing the benefit while staying compliant with tax regulations. Keeping proper documentation, such as Form 1098 from your lender, will help substantiate this deduction during tax season. Working with a tax professional can ensure you're taking full advantage of this powerful deduction while staying within IRS guidelines. 5. Using a pass-through entity, LLC or S-Corp. Structuring your rental property business under an LLC or S-Corp can provide huge tax benefits while also offering liability protection. These business structures allow rental income to pass through to the owner, avoiding the double taxation that corporations face. LLCs and S-Corp also allow landlords to take advantage of business deductions that aren't available to individual property owners. You can deduct expenses like business meals, travel, office supplies, and even retirement contributions under these entities. Another major benefit is the Qualified Business Income (QBI) deduction, which allows eligible landlords to deduct up to 20% of rental income from taxable income. This means if you earn $50,000 in rental income, you may only be taxed on $40,000. This is a powerful tax-saving tool that many landlords overlook. Additionally, an LLC provides legal separation between personal and business assets, protecting your personal wealth from lawsuits related to rental properties. Some states also offer additional tax advantages for ILCs, such as lower franchise tax fees or exemptions on certain income thresholds. S-Corp, on the other hand, can help landlords save on self-employment taxes by allowing them to pay themselves a reasonable salary and take the remaining profits as distributions, which may not be subject to payroll taxes. Another advantage is that having a formal business structure makes it easier to secure loans, attract investors, and scale your rental business while maintaining tax efficiency. Keeping detailed financial records and filing the necessary paperwork is essential to ensure compliance with IRS regulations and maximize the benefits of these structures. Before setting up an LLC or S-Corp, consult with a tax professional to determine which structure best suits your needs and long-term financial goals. That wraps up today's video on how to legally avoid taxes on rental income. I hope you found these strategies valuable, whether it's using depreciation, leveraging the 1031 exchange, or setting up an LLC. There are plenty of ways to keep more of your hard-earned money. If you want to dive deeper into real estate tax strategies, wealth building, and passive income tips, make sure to subscribe to the channel and hit the notification bell so you never miss an update. And if you found this video helpful, smash that like button and share it with anyone who needs to save on rental income taxes. Thanks for watching, and I'll see you in the next video.